Right now, as you're watching this video, India is in the middle of the biggest manufacturing transformation in its history. For decades, everything in your house, from phones, TVs, ACs, had one thing in common: made in China. But that is changing faster than most of the people realize. Over the next 3 years, a massive 27.7 lakh crore rupees opportunity is opening up. And that opportunity is made in India.
आदरणीय प्रधानमंत्री जी, आप जिसकी शुरुआत आज कर रहे हैं वो हमारे देश के विकास का एक नया वाहक बनेगा. And we want to make India a global manufacturing destination.
This development is a generational wealth creation opportunity. But here's the thing about generational opportunities: they do not wait for you to get ready. Now, the early investors in Infosys who bought it at 10 rupees in 1993 saw the stock rally up to 1,800. That is a massive bull rally. And the Sun Pharma buyers at 50 rupees in 2003 saw multi-bagger returns when the stock rallied up to 900 rupees. And I don't think I need to tell you about how Bajaj Finance made crazy money for its investors, right? So they did not just get lucky. They spotted the trend early. IT in the 90s, pharma in the 2000s, and lending finance business in the 2010s. So the question is, are you going to be a part of India's manufacturing revolution, or are you going to watch it from the sidelines and regret about it 5 years later? Because the stock that I am going to talk about in this video might be your last chance of getting in before this sector shows a boom. Now, the company that I am talking about has grown its sales from 263 crores to 4,905 crores in just 9 years. And that is 18x growth. And the profits have also expanded exponentially. And the stock, it has given unbelievable returns. But just now, it has dropped 47% from its peak due to recent market correction. Sounds interesting, right? So keep on watching this video if you want to know about this stock. Now, there are three massive trends converging right now to create this perfect storm. First is global supply chain diversification. Companies like Apple, Samsung, and Tesla are actively moving their production out of China and into India. Second is unmatched government support. The PLI schemes are not just announcements, they are already working. The electronic production in India has nearly doubled in the last 5 years. And the third is exploding domestic demand. India's middle class is buying more electronics than ever. Smartphones, TVs, ACs, washing machines, cars with electronic components, etc. So we are not just manufacturing for exports anymore. We are also manufacturing to meet our own massive market demands. And the result of these three massive trends is that the EMS sector is projected to grow from 75 billion USD today to 348 billion USD by 2031. So that is not just growth. That is a complete transformation of India's economic landscape. But here is the catch. We are still in the early innings. Most of this growth is still ahead of us, not behind us. So how do you actually invest in this mega trend? For that, let me introduce you to PG Electroplast, a company dealing with interesting situations that has caught my attention and shown me a massive opportunity. Now, recently, the company shares crashed 45% from their peak. And the reason? Reduced guidance and weak summer sales. But do not drop the video just yet. The company is good. If you understand why it fell, then you will see the opportunity. So PG Electroplast manufactures for Voltas, LG, Daikin, Blue Star, Haier, etc. Basically, every major brand expanding in India. So when these giants grow, PG Electroplast grows with them. And now, let us talk about the numbers because they are insane. Now, the revenue grew at 38.5% CAGR from 2016 to 2025. That means the revenue almost doubled every 2 years. And by FY 2025, the revenue hit 4,905 crore rupees. But wait, there is something even more crazier. The EBITDA grew at 42.6% annually. That is faster than their revenue growth. So this company is getting more efficient every year. But here is the problem. The room air conditioners generated 1015 crore rupees in Q1 of FY 2026. That is 68% of their total revenue. And the washing machines, just 8%. And electronics and others, 24%. So PGEL is dangerously dependent on ACs. But the CFO has explained about the stock crash in his recent con call. He has said that AC volumes destroyed their profit margins in the recent quarter, and the early monsoons in the month of May killed the AC demand. So companies like Voltas, Whirlpool, and Blue Star, all of them suffered, and PG Electroplast also got hit hard. So the sales and revenue did not meet the expectations. As a result, the stock crashed. But here is what the company is doing to fix this. They are partnering with Pax Technologies to enter India's payment and fintech hardware segment in India. They will be one of the few domestic manufacturers of POS. Now, what is POS? It is the machine which you use in shops for online payments. Now, digital payments in India are exploding, and the POS terminals have grown from 8 million to 11 million in just 2 years, and that is 22% growth. And PGEL is not just stopping over here. They are targeting 850 to 900 crore from their electronics division, and that is a 60% jump from their current 540 crore rupees. And their washing machine segment, I have to show you this. They are crushing it. They have shown 36% growth in Q1 of FY 2026, and the management is expecting 40 to 45% growth for the full year. Why? Because capacity expansion. They have capacity of 2 million units annually, and the washing machine demand is predictable, not seasonal like the ACs. So in short, the stock crashed because the company was over dependent on AC manufacturing, and that segment showed weakness due to early rains. But the management knows that the same thing might happen in the future as well. So they are diversifying into electronics and washing machines. So I am not worried or scared after seeing the recent fall. In fact, I am taking this as an opportunity. Also remember that despite of showing consistent growth in their sales and profits, the stock is trading cheaper than most of its competitors. Like Dixon Technologies is trading at 127 PE and Havells at 69 PE, whereas PG Electroplast, it is trading at 59 PE. So the valuations for the stock have significantly dropped down from 138 PE to 59 PE, which is a good sign. And the market is giving us a discount on a company which is positioned at the center of India's manufacturing boom. So this is an opportunity we should not miss. Now let us talk about the elephant in the room, the technicals. Now this stock has crashed 45% from its peak of 1055 rupees. So that is a massive discount on a fundamentally strong company. So here is what the charts are telling us. Now, if you take a look at the chart, 528 rupees is acting as a strong support level, and chances are that the stock might not fall below this level. But here is the thing. Now, I do not want to catch a falling knife, and this is a mid-cap stock, and mid-caps can be risky and sometimes brutal as well. They can stay down longer than you expect and test your patience like nothing else. So here is my strategy, and this is exactly what I am doing. I am waiting for a reversal confirmation. Now once this stock breaks and sustains above 659 rupees resistance, that is when I will start building positions. And why 659 rupees? Because that is where the momentum will shift from bearish to bullish, and that is where smart money will start pouring in and the stock will start moving up. So here is the bottom line. India's 27 lakh crore rupees of manufacturing boom is real, and PG Electroplast is positioned at the center of it. And the stock has crashed 45%, but the fundamentals are getting stronger. And my strategy, wait for 659 rupees breakout and then start building positions. And always remember, it is better to be right and late than being wrong and early. And remember that the stock will tell you when it is ready to move. Until then, we wait. So feel free to ask any doubts or queries in the comment section below. I am always there to help all of you. And do not forget to check out the detailed research report in the description below. And if this kind of deep dive analysis is your thing, then subscribe to Rangavan Finance, because your growth is our priority. So this was Sanika from Rangavan Finance. I will see you very soon in the next one. Till then, bye-bye. Now, rallied 75% in the last 2 years and it just hit. And Goldman Sachs has also said that it will very soon reach 1.60 lakh rupees. But here is the shocking truth. Buying any stock or any asset at its peak is risky. So in the next 8 minutes, I am going to solve this puzzle once and for all. That are we going to buy gold now, or are we about to see a long consolidation in gold for years?